Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get right to these UMich sentiment data. So basically, we're looking at a fall for UMich for the first time in 3 months, and you have the high cost of living really offsetting any sort of sanguine views on the job market, kind of the opposite of what the Fed was sort of looking at over the last few weeks. Joanne Shu, University of Michigan Surveys of Consumer Director, joins us now. Walk us through the decline here and the whys behind it.
Absolutely. So I would point out that this decline is not statistically significant. We should see this as, inching down a very, very small change. We're still higher than we were 2 months ago. That being said, consumers are, I think reacting to the same data that we saw in the CPI print yesterday. Inflation is slowing, but it's not slowing down as quickly as one would like. I'll note that the long-term inflation expectations actually came down a little bit. So, sort of mixed views on inflation expectations. And on labor markets, I think consumers are feeling a little bit more confident this month. We had been seeing a bit of a weakening in labor market expectations the last few months, but they did expect the Fed to step in. They did last month, and so consumers are feeling a little bit more stable there.
How does just interest rates coming down, is that just too much of a macro Wall Street-y thing to really impact the UMich data?
I don't think that the FOMC announcement necessarily moves the UMich data at all. It doesn't really move consumers. That being said, consumers are fully aware of the interest rates around them. And when we ask them about buying conditions for large purchases like cars or durable goods or homes, the spontaneous mentions of high interest rates has fallen this month. So consumers are perfectly aware that interest rates are going to have been falling. And 54% of consumers expect interest rates to continue falling in the year ahead. So this is something that's on the minds of consumers.
The narrative yesterday when we got the CPI data, initial jobless claims, is that which one does the Fed look at, right? Higher jobless claims or an inflation narrative, that disinflation narrative that's not as steep as we had thought? It feels like from the report, consumers are looking at those two things also. Jobs okay, inflation not okay.
Absolutely. I mean, I think that in terms of inflation and also high prices, that is absolutely the number one factor on consumers' minds. We have over 40% of consumers spontaneously telling us that high prices are eroding their personal finances. And it's been that way for quite some time. And so consumers are really concerned about that. With labor markets, consumers are not super concerned about unemployment. They are aware that labor markets have been strong for the last couple of years. They are, watching their incomes very closely, of course, but they aren't really afraid of losing their jobs in the year ahead.
All right, Joanne, thank you so much. We really appreciate that. Joanne Shu, she's Surveys of Consumer Director for the University of Michigan. So they don't make just good football players out there. They make some good economists and some good economic data out there in Michigan.
Don't they make cars?
They make cars, but not necessarily at the University of Michigan.
Oh, okay. I see the distinction.
I see what you're saying there.
Fair.
So that's all good stuff there. So UMich data coming in a little bit weaker than expected.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
What's really driving here are banks. I mean, JPMorgan having like a tremendous move, Paul. You got the KBW
I know.
bank index also rising the most since December 14th. You've been talking to people all morning. Did you find any cracks here?
Well, I mean, people were on the call talking about net interest margins, net interest income. And finally, Jamie Dimon's like, hey, guys, we put up some great numbers. Just lighten up about this net interest. I'm with him. I mean, and then I saw the Wells Fargo, being a former investment banker, I go right to the investment banking line. Man, they killed it.
Yep.
And
Wells Fargo, they haven't been able to grow in the same way because of the asset cap. So if they killed it now, imagine when the cap is finally lifted. Someone's smiling here, and I don't know if that's a good or bad thing. It's Alison Williams, Bloomberg Intelligence Senior Analyst for global banks and asset managers. Alison, what was your biggest takeaway from these two guys?
I mean, things are good, right? And then we got the PPI numbers. I think that's also giving a lift to the stocks. JPMorgan is fascinating because they beat the net interest income. The guidance looks better for fourth quarter, but Jamie making it a point to talk down the net interest income guidance for next year. And as you pointed out, really just getting annoyed with people like focusing so much on every little thing. He did make comments about the expenses, as we were discussing earlier this morning, just pointing out that, look, expenses are investments and investments in the future. But generally, showing, charge-offs coming in better than expected, but building the reserve, I think that reflects conservatism. Wells Fargo, also, they're actually releasing reserves. So what that means is that generally a better economic view on a lot of different things. They did build some for card and for commercial real estate.
All right. One of the many reasons I am not a bank analyst, because I focus on all the wrong things. Here's my question for Wells Fargo. Wells Fargo CEO, they've refurbished more than 460 branches this year. I haven't been in a branch since well before the pandemic. I'm like I got my app, I'm cruising on my app, I can do everything. Why do banks still have branches?
You
Why
still
do they
have cash in your pocket. I see you take it out.
Well, but I have about $400 or $500 because you never know when you're going to walk by a crap game. So talk to us about branches and what do they mean for the Wells Fargos and the Bank of Americas of the world?
So banks are still building branches. There's two reasons. So banks such as like Wells Fargo, Bank of America, JPMorgan, there is a cap in terms of what you can buy, so you have to organically build. So any states that they're not in, that they think are attractive markets, are building in those markets. But what they have been doing is reconfiguring those branches, so focusing more on wealth. So the branch may not be the, if you walked into a branch, you might not recognize it. Right. There is a JPMorgan branch in the middle of Summit, which hasn't changed very much, but but a lot of the branches in select markets are just making them smaller, more sales focused, focusing more on the wealth management business. So not necessarily your branch of the day of old where the focus was on deposits. Hopefully everyone's doing those on their phone because the cost to banks of processing those is pennies on the dollar.
John, you can deposit a check by taking a photo of the check and then
I actually have done that. But there are things like they're doing everything they can to make me go paperless. I absolutely refuse.
Really?
I want to be
so much
as
easier.
Big of a drag as possible.
And then you wonder why we make you out to be a curmudgeon. And we're like, we don't do it. You do it yourself.
I fully admit it.
What would be your questions now? So we got through this quarter, et cetera. What's your biggest question for JPM and for Wells Fargo?
I mean, when is loan growth going to get a little bit better? So that is, I think, one of the benefits of interest rate cuts that you're not necessarily going to see in their projections, right? Because I think they're going to want to see more evidence of that loan demand. Card has been really strong. And the reason why we're seeing reserves for card is really not... We have some normalization of credit, but it's really the growth. So when are the other areas going to pick up? The other thing is fees. Fees have been helped by the super strong markets. And I think that's, if you look at Wells Fargo's stock today, yes, net interest income was softer in the quarter, but next quarter looks fine. And the markets are doing better. That's not necessarily a question that management can answer, but it's something that we think is going to continue to benefit the banks.
All right, I have my checking account with Wells Fargo, so I think I'm prepared to ask this question. Explain to us what the regulatory and legal issues are still above Wells Fargo, and when do they hope to get out from under that?
I mean, the asset cap is unprecedented.
What is an asset cap?
Basically, after, if we go way back, so 2016, they were fined for some different sales practices. Right. They had to make some improvements. They weren't making them fast enough. So within about a year or so, they got this asset cap, which said, look, you're not allowed to grow from where your assets are today until, you fix the things that we want to fix. And that had never happened before. And so initially the thought was, this will be a few months. So many years later, they are still working to fix that. And, since then, that was a prior CEO. So we had a change at the top in terms of management. We had the board turnover. We've had tons of processes changing. There was a Bloomberg News article recently about, sending to regulators all the changes that they've made. But at this point, it makes less of a difference. It really hurt them during the pandemic because they were limited in terms of the deposits they could add. But it is really about sentiment and flexibility. Should there be another big opportunity for them created, they want to make sure that they have that flexibility.
Yeah, and if you talk to management, they're like, it's a process. Like, they can't give a date or a time because it's about transparency and rules. So like when they keep making the transparency and rules happen, at some point that will be lifted. 30 seconds. Which bank now that is left to report do you think does well based on these results?
I mean, Goldman Sachs. Goldman Sachs and Morgan Stanley. So Morgan Stanley is more skewed towards the equities business, right? Their trading has more exposure there. Equities trading super strong at JPMorgan. Those three banks are the top in the business, and so we expect to see more strength next week.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So here's a story I don't understand. So it's a great story to then talk to Bloomberg Intelligence about. A TD Bank is going to pay almost $3.1 billion in fines and other penalties and face a cap on its U.S. retail banking assets. This is after pleading guilty to failing to prevent money laundering by drug cartels and other criminals. We got the legal side, we got the business equity side for you here. Elliot Stein is Bloomberg Intelligence litigation analyst, and Paul Gulberg is Bloomberg Intelligence senior equity analyst. Elliot, start with you. Explain to me the legal story here.
Right. So yesterday, TD Bank became the largest bank in U.S. history to plead guilty to money laundering violations. They paid $3 billion, which is now the most any bank has ever paid for money laundering violations. And they are now only the second bank to have an asset cap imposed on them after Wells Fargo over 6 years ago. Although it should be noted that the asset cap on TD Bank is only limited to its U.S. retail bank operations, so it's sort of a smaller asset cap than the one imposed on Wells.
Hey, Paul, how much does this impact what investors kind of their view of TD? $3 billion is a big number, Elliot says, but they got $120 billion in market cap. So what do you think?
Yeah. Hi, Paul. The $3 billion is not that big of a deal for them as a bank. They have 13% of capital ratio. And they reserved most of it already, just shy of a few dollars there. The asset cap is a bigger issue, and it's going to impede growth. Now they gave some ins and outs, what they're going to do, trying to accommodate the new requirements from the regulators. They're going to cut their U.S. assets for those retail banks by about 10%. It's going to be an additional $1.5 billion charge. And even excluding that charge, some of the actions that we saw, when we ran the numbers, it could be as much as another 30 cents on the earnings. So another few percent of the earnings are going to get shaved in next year. And how long is it going to take to unwind? It's going to take some time.
This might be a silly question, Elliot, but like, what did they actually do, and how they actually fixed that part of it?
Like, who launders money anymore? I didn't know.
Yeah, so the laundering here was by Chinese drug cartels and other drug cartels as well. And I think what's notable is that TD Bank employees were accepting bribes from these cartels. Yeah, a couple of them were indicted previously, a couple of TD Bank employees. So I think that's what made this sort of a more egregious case, because usually with banks you see that their AML processes are deficient. Here you have bank employees participating in the crimes, and that can get imputed to the bank itself, and that's what made it the worst case.
Paul Gulberg, I'm looking at the stock kind of flat on the year. What's the call on a bank like TD, and maybe just Canadian banks in general?
Canadian banks sort of sitting at a crossroads. As the Bank of Canada started cutting interest rates ahead of the Federal Reserve here, they've done 3 cuts already. They kind of sit in between the two worlds. One is the slower growth and the risk of actual recession, which is kind of minimized at this point. And the other one is the profitability. The loan growth slowed quite dramatically in Canada and somewhat in the U.S. And their mortgage market is a little bit different than the U.S. when mortgages reprice to a higher rate, which exposes consumer to a very different risk. And about 75% of mortgages overall, and a lot of them that were issued at a very low rates during the pandemic, due to reprice in 25 and 26. So a lot of what's going on and what might happen, people are looking at the Bank of Canada and how well it can actually prevent that from spilling over into consumer pains.
So then based on that, when you take a look at the stock, is down by about over 2% today. Do we see, it was down about 6%, I think, yesterday. What part of this is reflected in the stock? How much of the macro, Bank of Canada, and then how much of this kind of legal fees, et cetera?
So I think the macro has been reflected in the stock for quite a while because relative to peers, it's been underperforming all year. And the story on the whole kind of the AML story has been around for over a year as well. So a lot have been reflected as well. I think what people were not really expecting is the asset cap. And even though, as Elliot said, it's only the U.S. retail operations, so the assets of those two operations are only about 30% of the total bank assets. It's still kind of unexpected, and that's what's pressuring the stock. They gave sort of clarity in what might be the pressure in 25, but the question is, and this is kind of goes back to Wells Fargo, where every quarterly call, people are asking when are you going to be done with the cap, and we've been out there for 7 years already. So what's priced in there in that respect is kind of hard to tell.
Hey, Elliot, this asset cap, which I just learned about like 15 minutes ago when Alison Williams explained it to me in the context of Wells Fargo, so now I think I know all about it. This seems like a real deterrent for regulators to rein in, banks' behavior here. I mean, writing a check is easy. They can reserve for it, no big deal. This seems like it could really have some teeth.
Yeah, and I think it's sort of a new wave of enforcement weapons that regulators are bringing. Because you did have Wells Fargo's asset cap almost 7 years ago, but more recently, we've seen the OCC impose different business limitations on Wells by requiring them to get OCC approval if they're going to expand into new products or new markets. And we saw that with TD Bank yesterday as well, because in addition to the asset cap, if TD's U.S. operations want to expand into new markets or open new branches, they have to get OCC approval as well. So we're seeing new tools that regulators are using beyond just monetary penalties, which, critics say are, just the cost of doing business.
So for Wells Fargo, part of it is for the broader asset cap lift. It's sort of like, when you see it. Like, it's nothing you can point to that, like, they're going to fix this and then all will be well. That's sort of just transparency and rules. They have to just clean up and they have to just do better. What is it for TD?
It's similar to what Wells Fargo went through, but, there's no... That's the problem.
There's no magic moment?
It's sort of, exactly. It's up to the OCC. There are steps that the bank has to take along the way, right? They have to put in a plan that the OCC approves, then they have to implement the plan, then they have to get a third-party independent reviewer to sort of sign off on it, and then that third party presents it to the OCC, and then the OCC signs off on it. But there's no crystal clear moment.
That's interesting.
Yeah, where it gets lifted.
That's interesting. Also, it's like, how do you prove that your workers are no longer taking bribes? Like, what does that look like?
Right, it's like proving a negative.
No, we promised. Yeah, it's like proving a negative. Exactly. Guys, really interesting story. We thank you both. That was really fun. Elliot Stein, Bloomberg Intelligence litigation analyst, and Paul Gulberg, Bloomberg Intelligence senior equity analyst, talking about TD Bank.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So we had the PPI, which seemed pretty benign. You have nothing really happening in the front end. Long end, though, still selling off. Joining us now is Priya Misra, Chief Fixed Income Portfolio Manager at JPMorgan Asset Management, joining us there. Priya, what is going on with the long end? Why the sell-off? Is there something fundamental? Is it repositioning? Is it something else?
I think it's a combination of a couple of things. So we had this really strong jobs report. Now, I know it's one report. It is subject to revisions, but I think the broad-based strength of that report, I think, is making the market consider exactly where is neutral rate. And I think that neutral rate, if you were thinking the Fed's around 2.9, what if it's 3.5? What if it's 4? I think that's part of it. So we saw that repricing starting with that report. The other one is we have an election in less than a month out. And I think we can debate, the makeup of Congress, the presidency, but fiscal restraint is not something either party is talking about. Even in a divided government scenario, I think there's a case to be made that the taxes will get extended, a lot of the spending will continue. So I think the market is reassessing that term premium. Now we're not worrying about inflation or growth, we're worried about what is the outlook after the election, and with all this fiscal question mark out there, I think we're reassessing how much will the Fed cut. And what should be that term premium? How much more should you get paid if you're giving the government money for 2 years versus 10 years? And I think it's the combination of the two, along with probably some positioning. I think the market was long, given the previous two payroll reports. We were long into that payroll report. That's why the long end has sold off. I think we're starting to see some value, but before the election outcome and before realizing what's happening on the fiscal front, I think people are going to be nervous to step in and really buy the long end.
All right, Priya, in terms of credit, how much credit risk do you want to take these days? Because, again, you can sit in a 2-year treasury and get close to 4% here.
Right. I think, and credit spreads are tight. On any historical metric, you could argue I'm not getting paid up enough for credit. Here's why I'm going to argue that high-quality credit or owning high-quality corporate paper, even with these tight spreads, makes sense. So 2 points on that. Number one, you talked about I can be in the very front end and still earn 4%. Well, we think the Fed's going to continue to cut. The urgency for 50 is clearly not there, but I think a gradual pace of 25, getting close to a 3 or 3.5 on Fed funds. So that front end or money market yield where you may have, it's felt great to be there, that yield is going to go down over time. Secondly, look at corporate America. I mean, we're in a soft landing. This is the time when you should be picking up a little bit more spread. You have to be careful, you know what you're buying. But in the investment grade corporate market, I would even go as far as the high quality high yield market. So the double B, even some single B look attractive. I mean, look at balance sheets. What are companies doing with the debt that they're issuing? They're not re-levering up. This is not end of cycle behavior from corporate America. There has been issuance, but it's been taken down really well. The issuance is all pre-funding maturities that are coming up. So companies are very smartly trying to push out that maturity wall. So I would say if you're picking up 100 basis points in high quality IG, investment grade, or 200 in high quality high yield, it makes sense. As long as we stay in a soft landing, pick up that yield and extend out the curve. Maybe 30 years too far out, 5-year corporate bonds, I think make a lot of sense as long as we stay in the soft landing. And the data or Fed policy is telling you that the soft landing should be our base case.
Well, it's just so crazy because I feel like in the beginning of August, it was a growth scare and then it was a soft landing. And now there's some talk about, are we actually reaccelerating here and the Fed's going to have to pause? Now that conversation, like Bostic pointed out, Raphael Bostic this week supported that. This is just such a weird time. Like, how do you manage that kind of narrative shift?
I completely hear you, Alix. I think the market flips from one narrative to another very quickly, every data point based. I think part of it is the Fed keeps telling us that they're not data point dependent, but there is no forward guidance. And we went from pricing in 25 to 50 within a week to now pricing less than 25 at the next meeting. So I think the market's clearly treating Fed policy as data point dependent. But here's what it boils down to. The data is mixed. I mean, there's some signs of slowing. I think we don't know. I think the last time I was on, I was telling you, I don't know if we're slowing to potential or below potential. I think we're still in that same place. Before the payroll report, you could point to a couple of data points on the labor market, and I think it will come down to the labor market. So watch claims. And here's the bad news in this. We're not going to have very reliable data in the next few months because the impact of the strikes, the impact of the hurricanes. So we're going to have to look at the totality of data as the Fed is doing and then see, is it convincingly leading us one way or the other? I think the market's overdoing the moves on both directions. We didn't think a recession was very likely early August. I don't buy the no landing scenario right now. I think we're slowing. Here's the thing, soft landings are rare. The Fed hasn't really been able to pull it off before. So I think it's understandable why the market's skeptical. But maybe this is the one time where somehow they're able to cut rates to neutral or to whatever is their estimate of, or the economy's estimate of neutral at the same time as the economy slows down. So perhaps this is the one time where we'll be in soft landing. But I think we should be careful not to swing from one end to the other end. The market is. And I think that's where we get opportunities. I think if the market prices out any more cuts in the front end, we'd be looking to buy the 2-year. I don't think the Fed stops the easing cycle, but the market can certainly run with the narrative in one direction.
Priya, are there any industry sectors that screen well for you, given that background?
Sure. So there's these growth sectors. Utilities, for example, was not necessarily, I would have said that that's a growth sector 2 years ago, and here we are. Electrification, AI. So I think within the investment grade sector, I would say utilities make sense. There's areas in communication in the high yield space where we think, the sector might have been beaten down a little bit. We think there's value there. Financials. Now, financials have done well, but we still think that there's value. I mean, I'm going to be looking at the earnings season starting out, and we just got the banks. What I'll be watching is, do margins stay strong? Because, if revenue growth, if the economy is slowing, I mean, we're likely slowing to trend or just below trend, not recession. But if we are slowing and companies have already gotten a lot of productivity out of, what they could do to keep costs low, it's going to come down to how much further can they do on the productivity side. And so if margins remain strong, I think then there's a lot of sectors you can look at. I mean, there's certain sectors I think you have to look at valuations too. I think many sectors make sense, but if the market's already priced that in, we stay away from that. Industrials, in our view, look rich from a valuation standpoint. But financials, utilities, there's a bunch of sectors. Securitized credit. I think people look at CMBS and get nervous, commercial real estate. But look at single-family rental. Housing is still very unaffordable. So people are forced into the rental market. You have a job, you're earning, you're making your rent payment. That's a sector that makes a lot of sense. It's positive cash flow. So unlike equities where I think you have to have a view on tech, I think in fixed income, it's like making me pick between my children. It's hard. There's opportunities in many sectors.
Priya, we appreciate it. Thank you so very much. We always love when you join us. Priya Misra joining us at JPMorgan Asset Management. She is a fixed income portfolio manager.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm going to say really over the last couple of 3 years that the regulatory hand of the U.S. government's gotten a little heavier on the shoulders of big tech companies, and that includes our good friends at Google. Jennifer Reed joins us here. She's a senior litigation analyst for Bloomberg Intelligence. I like what she writes here. If the U.S. Justice Department asks Alphabet's Google to divest part of its business as a remedy for illegally maintaining monopolies in general search-related ad markets, we think the DOJ will probably fail. Jen, what's the thinking behind that? Because there is some increasing talk here that the Department of Justice may, in fact, ask for some type of breakup of Alphabet.
Yeah, and they've suggested that they are going to ask for that. We'll find out mid-November. But the reason why I think this, and I'm sorry because I'm going to have to get a little nerdy with you here.
Yeah, bring it. I took one class.
Okay, all right, get ready here. This judge has adhered so closely to the old Microsoft monopolization decision back in early 2000. The entire litigation, he said that is his blueprint. And all through his decision on liability, he cited Microsoft, Microsoft, Microsoft. And what Microsoft says is that the standard for finding that the conduct, and here it was these default agreements that Google had to put search and basically all the distribution channels, right, in the internet, that to find liability, you just have to find that it's reasonably probable that these agreements contributed to maintaining the monopoly in search. But what Microsoft said is for remedy, if you're going to use divestiture, that standard is much higher. In other words, you need to kind of have a but-for standard. You have to be really certain that but for those agreements, Google wouldn't have the position in search it has today. And that this judge said over and over that Google got to this monopoly position by having a better product, not by behaving badly, but by basically innovating and making this great search product that people loved. It got to this monopoly position, and it was only after it attained that position that it behaved badly to maintain that spot. So I think given this much higher standard for what's called causation in the Microsoft case, and this judge's adherence to Microsoft, he's not going to go that far.
So that was a pretty nerdy assessment, but like I think I got it. But I kind of got it.
Somewhat nerdy,
like
yeah.
that definitely works for me. What about behavioral remedies?
Mm-hmm.
And what does that mean?
Yeah, I think we're going to see quite a lot of that because the DOJ kind of threw in just about everything that's possible here. Behavioral remedies means you can or can't. We are going to make you do things or tell you you can't do things, right? It's just how you conduct your business and how we're going to tell you you have to conduct your business. So in this case, very likely it's going to be Google can't pay Apple to insert Google search as the default behind Safari. It can't pay the OEMs like Samsung making the Android phones or require them as a condition to having Google Play or YouTube or some other really desirable app that the OEMs want to pre-install. You can't condition that access to Google Play on also putting Chrome or search front and center and keeping all the other rivals in browser and search off the phone. Things like that. Also, possibly some data sharing, because what this judge found is that over the years, through the volume of searches Google had, they had the scale to develop and become better, whereas Bing and DuckDuckGo and some of the other new rivals didn't have that scale and couldn't improve. And that data is super important, as well as the indexing of the web and the crawling of the web and all of everything Google did to create this great search engine. So Google may have to share some of that data with some of these search rivals to help them try to get better.
Timing. I know you guys bill by the hour, so timing's very important. This thing just screams appeals and years and years and years. But give us a sense of how you think the timing might play out.
This is going to take a long time. Okay. I mean, I don't think we see any real impact on Google soon. So the final remedies won't be decided till August. So we have a long time before we even know what the judge orders. At that point, Google will be able to appeal. They will appeal. They've already said so. And what they'll do is ask for a stay of this injunction. In other words, just freeze it in place pending our appeal. We don't have to do anything. We don't have to change anything. Usually a company does win that kind of thing, right? If we look at Epic Games versus Apple, where Apple lost on just a very slim piece of that case, and there was a limited injunction, that got stayed for almost 2.5 years. So it was issued in September 2021, didn't go into effect until this past January. So it was a long time before Apple had to do anything, and I think we're going to see the same thing here.
Does this ruling change if someone else is in the White House? I mean, even if it's President Harris and she takes a different approach to this kind of stuff, does this change?
It's absolutely a possibility.
Okay.
Now, I tend to doubt it, but it is a possibility because we will have different decision makers at the DOJ. It's very likely. And those different decision makers could just decide to discuss settlement. This is exactly what happened in the Microsoft case after Microsoft partially won on appeal, but at least the order by a trial court in that case to break up Microsoft was reversed on appeal. And later, we had a new administration, George W. Bush, and the case settled. It's possible. We have heard from former President Trump and J.D. Vance. They're both not a friend to Google. They've been pretty vocal.
It's like this is like maybe one area where both sides actually weirdly agree, but they won't say it.
I think that's right. They won't really say it, but I do think they weirdly agree. And I don't really think such a high-profile case that either one of them are going to back off and have some slap on the wrist settlement.
Remind us, what else does Google have out there that would interest you?
So we have the AdTech case too.
Okay.
Different markets. This is the AdTech stack, right? Demand side and sell side options for publishers and advertisers to come together and sell advertising on the internet. And that trial just ended at the end of September, and that is moving really fast. So the weird thing here, Paul, is we could have a decision and a remedy in that case before we have one in the search case. So it's which September a year ago finished up. My colleague's been following that, and he does also think there will be a ruling against the DOJ on liability. But just like I see the search case, he doesn't see the remedy ultimately being a divestiture or some forced sale of, let's say, DoubleClick, which is part of the Google ad stack business. So we have that. Europe is also looking at Google, obviously. They're looking at the AdTech stack as well. They've talked about a breakup. I'd be surprised if Europe went that far, if the United States courts don't go that far. But, Europe has a tendency to impose really, really big fines. And we've seen that, so that could still happen down the road.
Interesting.
Boy, this Lena Kine person, is that her name?
FTC, Lena Kine.
Lena Kine, yeah.
Lena Kine.
But different from DOJ.
Different from
DOJ, but she's also out there.
Yes.
And she's very aggressive, correct? I mean,
yes, very aggressive, especially in merger challenges.
Yeah.
Yeah, DOJ's been less aggressive in the merger challenge side. She has her monopolization cases against Amazon and Meta still pending, but a lot of merger challenges.
Yeah.
You have to wonder, does that continue too? I mean, in that, even if she's not head of the FTC, when we wind up getting a new president, like say President Harris takes the game. is this still a sea change in how we look at antitrust? Still a sea change of how we look at M&A versus a one-off, which I think could be something.
I think there's a change. I don't see us going back to where we were 5 years ago when it was kind of assumed most problematic deals would settle with a remedy. I just don't see us going back to that.
Yeah.
I think more aggressive antitrust enforcement has taken root, and I think it's here. Could there be some easing, a little bit of less rigidity? Yes, I think that's possible.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.